Good afternoon. Thank you for joining Tetragon's 2019 Annual Report Investor Call. You are all in listen-only mode. The call will be accompanied by a live presentation, which can be viewed online by registering at the link provided in the company's conference call press release. This press release can be found on the homepage of the company's website, www.tetragoninv.com. In addition, questions can be submitted online while watching the presentation. As a reminder, this call is being recorded. I will now turn you over to Paddy Dear to commence the presentation.
As one of the principals and founders of the investment manager of Tetragon Financial Group Limited, I'd like to welcome you to our investor call, which will focus on the company's 2019 full year results. Paul Gannon, our CFO, will review the company's financial performance for the year. Steve Prince and I will talk through some of the detail of the portfolio and performance. And Steve will spend some time discussing the outlook. As usual, we'll conclude with questions, those taken electronically via our web-based system at the end of the presentation, as well as those received since the last update. The PDF of the slides are now available to download on our website, and if you're on the webcast, directly from the webcast portal. I would like to remind everyone that the following may contain forward-looking comments, including statements regarding the intentions, beliefs, or current expectations concerning performance and financial condition on the products and market in which Tetragon invests. Our performance may change materially as a result of various possible events or factors. So with that, over to Paul.
Thanks, Paddy. So as a reminder, Tetragon continues to focus on three main metrics. We look at how value is being created via NAV per share total return. We also look at investment returns measured as a return on equity or ROE. And finally, we monitor how value is being returned to shareholders through distributions, which are mainly in the form of dividends. The fully diluted NAV per share was $24.76 at the end of 2019. After adjusting for dividends reinvested at the NAV per share total return for the year was 13.6%, which compares to 10.3% for the full year in 2018. For monitoring investment returns, we continue to use an ROE calculation, and for 2019, this has been 13.4%, which is net of all fees and expenses. And we're pleased to say that this is within the target 10 to 15% return range. With reference to that target, the average ROE achieved since IPO remains at 12.4%. Later on in the call, we'll give more colour as to how the specific asset classes contributed to the return this year. Finally, moving on to the last key metric, Tetragon declared a dividend of 18.75 cents for the fourth quarter, which represents a full-year dividend of 74 cents. This is in line with a progressive dividend policy which targets a payout ratio of 30 to 50% of normalised earnings, and based on the year-end share price of $12.25, this represents a yield of approximately 6%. So now on to what we call the NAV bridge. This breaks down into its component parts, the growth of Tetragon's fully diluted NAV per share, from $22.48 at the end of 2018 to $24.76 per share at the end of 2019. So you can see from the bridge, investment income contributed $4.23 per share. Operating expenses and manager fees then reduced NAV per share by $1.10, with a further 4 cents per share reduction due to interest expense. On the capital side, gross dividends reduced NAV per share by 73 cents. There was a net dilution of 60 cents per share, which is labelled as other share dilution. This bucket primarily reflects the impact of dilution from stock dividends, plus the additional recognition of equity-based compensation shares. Finally, the impact of the $50 million share buyback, which was launched in 2018 but did not close until January 2019, resulted in 52 cents of NAV accretion. I will now hand back over to Paddy.
Thanks, Paul. As As on previous calls, I'd like to put the 2019 performance in the context of the long term. As a reminder, Tetragon began trading in 2005 and became a public entity in April 2007. So we're now coming up to nearly 15 years of investing history in this fund. The chart we have here shows the NAV per share total return, which is the thick line at the top, the share price total return, which is the dashed line beneath it, and the chart also includes equity indices, both the MSCI All-Share and the FT All-Share. It also includes at the bottom the Tetragon hurdle rate of LIBOR plus 2.65. As you can see, since IPO, Tetragon has returned 294% on a NAV total return basis. That is near a fourfold increase in value since IPO. Continuing the theme of looking at the long term, here are some more long-term performance data. Our return on equity, which is the investment return each year, target is 10 to 15% net to investors over the cycle. And the average return since IPO is currently 12.4%. As Paul has shown, Tetragon's return on equity for 2019 was 13.4%. So within that range. And we're pleased with the 2019 performance in the broader historical context. Long-term interest rates are down to their lows again. The US 10-year Treasury is approximately 1.25%. And with risk-free rates so low, we should naturally expect all risk assets to return at the lower end of long-term expectation. Thus, with respect to Tetragon, this means that ex-ante, our return expectations are at the bottom end of our 10 to 15% range for the cycle. The last figure on this table shows that 30.8% of the public shares are owned by principals of the investment manager and TFG Asset Management employees. We believe this is very important as it demonstrates a strong belief in what we do, as well as a strong alignment of interest between the manager, TFG Asset Management employees, and Tetragon shareholders. This next slide shows the composition of Tetragon's assets. So looking at the breakdown of the $2.4 billion of NAV, these colored discs show the percentage breakdown of the asset classes and strategies as at year-end 2019, which is on the right, and compares them with year-end 2018 on the left. I would pick out some notable changes year on year. First, growth in private equity from 7 to 12%. This is a deliberate result of making new investments, and these are allocations to external managers, which is a strategy discussed at length last year and again in the annual report. Second, we have seen an increase in other equities and credit from 6% to 9%. This is more of an opportunistic approach and will fluctuate with the ideas that we find, and we add new positions during 2019. Third, there has been a decline in cash, which is a result of many things, obviously using cash to make investments, a repurchase of shares that we did in January, and paying dividends, amongst other things. Future cash commitments are approximately $217 million, and Steve will provide more detail on that a bit later on. I would note that Tetragon currently has $150 million of a revolving credit facility in place, and that was fully drawn as at 31st of December 2019, and that liability is incorporated into the net cash balance calculation. Now let's move on to discuss the full year performance in more detail. The NAV bridge that Paul showed was a high-level overview of the NAV per share. This table shows a breakdown of the composition of Tetragon's NAV at 31st of December 2018 and 2019 by asset classes and the factors contributing to the changes in NAV. Thus, this table shows investment performance plus capital flows and so tying back to the change in NAV. As you can see from the bottom row of the table, investment performance, labeled gains and losses, or the column labeled gains and losses, generated $402.5 million of gross profits for the year. TFG Asset Management, our private equity holdings in asset management, generated $164.6 million of that, driven primarily by Equitix, LCM, and Benthall Green Oak. Hedge fund strategies contributed $53.3 million of that, with a particular strong performance from the Polygon European Equity Opportunity Fund. Bank loans generated $30.9 million of the gross profits. Private equity and venture capital generated $131.7 million of those gross profits, primary source of which being investments in direct private equity stakes. Real estate generated $27.7 million of those profits. And finally, other equities and credit made a loss of $12.5 million. Now, for more detail on each of those categories, and starting with TFG Asset Management, pass over to Steve.
Thanks, Patty. Our private equity investments in asset management companies through TFG Asset Management represented the largest asset class in the portfolio at the end of 2019 and produced $165 million of gains during the period. Equitix was the most significant contributor during 2019 with an investment gain of $121.8 million. This gain was primarily driven by a combination of performance, capital raising, and accelerated capital deployment. Assets under management grew 40% to $7.1 billion, compared to $5 billion a year ago. Fund 5 closed in the second quarter of 2019 at £1 billion. Eurofund raised 500 million euros of capital by the end of 2019, with the first close of Fund 6 expected in Q1 2020. These milestones represent an acceleration in capital raising and deployment targets from prior years. During the year, Equitix repaid $54.9 million of loan notes, including accrued interest, to Tetragon. The second highest contributor was LCM, which recorded a gain of over $28 million, nearly all valuation gains. The business continued to perform well as LCM continues to issue deals and raise capital with a lower than market average default rate. The third largest contributor was Benthall Green Oak. As has been previously highlighted, Green Oak announced in December 2018 a merger with Benthall Kennedy, Sun Life Financial's North American real estate and property management firm, to form Benthall Green Oak. The merger closed on the 2nd of July 2019, and TFG Asset Management continues to own nearly 13% of the combined entity. Polygon's value fell by $7.8 million during the year, primarily reflecting lower than budgeted capital raising and a change in the expected future UK tax rate. The value of Tetragon Credit Partners increased by $8.5 million in 2019, driven by the increase in capital commitments, the amount of capital deployed, as well as an increase in projected carry. Hawke's Point NAV remains small. AUM at the end of the year was approximately $82 million, although progress has been made in 2020 with positive developments on 2 of their existing positions. Banyan Square Partners is our newest business. Banyan Square is a private equity firm focused on non-control, structured, and common equity investment opportunities and seeks to support private equity acquisition, financing, growth initiatives, and liquidity events. Tetragon's investment in Banyan Square Partners has not yet been valued by a third-party valuation specialist. In 2019, TFG Asset Management's EBITDA was $59.5 million. 51% higher than 2018. Higher management fees due to continued AUM growth and higher performance and success fees due to better performance of the funds was the driving factors for this increase. Management fees increased by 30% year over year, driven by Equitix, and Tetragon Credit Partners drove management fee growth as well as LCM. Performance and success fees grew up $27.8 million during the year, driven by Polygon and Equitix. Other fee income increased 19%. Other fee income comprises a number of factors. Number 1, income generated by Equitix on management services contracts, which is known as the EMS business. Second, third-party CLO management fee income relating to certain U.S. CLO 1.0 transactions. And third, certain cost recoveries from Tetragon relating to the seeded Polygon hedge funds. An increase in EMS fee income was behind the growth in this category of income and now accounts for 89% of this bucket. Distributions from Bental Green Oak reflect 1. Distributions from ongoing operations, and 2. Distributions from carried interest. Up until 2018, carried interest was made up nearly 80% of these distributions. However, post the Bental Green Oak merger, carried interest distributions are supplemented by the fixed and variable payments agreed as part of that deal. For 2019, fixed payments contributed $7 million, with carried interest accounting for the remainder. Operating expenses increased by $30.4 million year-on-year, with $9 million coming from Equitix, as this business has added headcount and continued to scale up. As expected, bonus expenses also increased in those business lines where performance fees increased significantly. Tetragon Credit Partners also saw an increase in costs, reflecting an increased allocation of resource to this business line with the launch and successful raise of TCI3, as well as to support new business lines. We continue to view the increase in expenses as an investment to support greater AUM growth in the future. Patty will now go over our hedge fund investments.
Thanks, Steve. Tetragon invests in event-driven equities, convertible bonds, and quantitative strategies through hedge funds. As at the end of 2019, 3 of these 4 investments are through Polygon-managed hedge funds, with the 4th being through QT, an external manager. Our investment in the Polygon European event-driven strategy made $47.4 million for the year. Our investment in the Polygon convertible bond fund made $4.9 million for the year, and our investment in the Polygon Global Equity Fund lost $0.5 million for the year. Lastly, our investment in the QT Quantitative Fund made $1.5 million for the year. The Polygon funds continue to show strong alpha returns over multi-year periods, and we were very pleased with the recognition when the Polygon European Event-Driven Fund won the award for Event-Driven Fund of the Year 2019 at the recent annual EuroHedge-sponsored Hedge Fund Awards. I would also note that post-year-end we have redeemed from the QT Fund and expect our proceeds in Q2. Moving on to bank loans. We continue to view CLOs as attractive vehicles for obtaining long-term exposure to the leveraged loan asset class. And Tetragon invests in bank loans primarily through CLOs by taking majority positions in the equity tranches. This asset class generated $30.9 million of gains during 2019. During the year, Tetragon exercised its optional redemption and refinancing rights on certain CLO transactions and made new U.S. CLO investments indirectly via the Tetragon Credit Partners platform. The TCI2 investment fund. As of the 31st of December 2019, Tetragon's commitment to TCI2 was $70 million, and that has been fully funded. During 2019, Tetragon's investment in this fund distributed $8.6 million in income to Tetragon. TCI2 successfully refinanced certain debt tranches in 4 CLOs during the year, reducing the interest cost of debt on those transactions, and all things being equal, increasing the future expected cash flows to the equity tranches. TCI3 had its final close in 2019, bringing the total committed capital to $429.5 million. Of that, Tetragon's commitment is $85.9 million, and of that, $71.8 million had been drawn as at the end of 2019. By the end of 2019, TCI3 had made 12 investments and expects to complete its initial investments in early 2020. During 2019, TCI3 distributed $6.6 million in income to Tetragon. Next is real estate. Tetragon holds most of its investments in real estate through Benthall Green Oak managed funds and co-investment vehicles. The majority of these are private equity style funds concentrating on opportunistic investments, targeting middle market opportunities in the US, Europe, and Asia, where Benthall Green Oak believes it can increase value and produce positive, unlevered returns by sourcing off-market opportunities, where it sees pricing discounts and market inefficiencies. The real estate investments generated $27.7 million of gains during 2019. Of that, Europe funds and co-investments generated gains of $6.6 million. US funds and co-investments generated a net loss of $0.3 million. And Asia funds and co-investments generated gains of $24.4 million. The debt funds generated a positive $0.4 million. In addition to the commercial real estate investments that we have through Benthall Green Oak managed real estate funds, Tetragon also has investments in commercial farmland in Paraguay, managed by Scimitar, a specialist manager in South American farmland. During 2019, the farmlands were revalued, which reduced the market value by $3.4 million. Now I'll hand back to Steve.
Thanks, Patty. Tetragon's private equity and venture capital investments are split into the following subcategories: investments managed by Hawke's Point, investments managed by Banyan Square Partners, other funds and co-investments where Tetragon invests in a non-affiliated fund as a limited partner or in a special purpose vehicle as a co-investor, and direct, comprising direct private equity investments on the balance sheet, including venture capital investments. Tetragon's investment into mining finance via a vehicle managed by Hawke's Point generated $36.1 million of net income in 2019. Tetragon made its first investment into an asset managed by Banyan Square in Q4 2019. Banyan Square's first investment was alongside a leading technology-focused private equity fund, where that fund took private a travel-related technology company. Tetragon had a 1.8% allocation to investments in private equity funds and co-investment vehicles in Europe and North America. This category generated a gain of $7.8 million in 2019. Lastly, investments in direct private equity stakes, including venture capital, generated net income of $87.8 million in 2019. The main driver of net income relates to the partial disposal of a pre-IPO investment. This segment now represents 6.3% of NAV. Our direct balance sheet investments in the other equities and credit category produced losses of approximately $12.5 million during 2019. Our other equities bucket generated losses of $19.3 million. These investments comprise European and U.S. listed public equities. Biotechnology positions and one event-driven investment drove the losses, which were still held on the balance sheet at 31 December 2019. The other credit bucket generated a gain of $6.8 million in the period, driven by corporate bond positions. Tetragon's net cash balance, which is cash adjusted for known accruals and liabilities, was $55.4 million at the end of the year. As mentioned previously, Tetragon currently has a $150 million revolving credit facility in place, which is fully drawn as of the end of the year. This liability has been incorporated into the net cash balance calculation. The company actively manages its cash levels to cover future commitments and to enable it to capitalize on opportunistic investments and new business opportunities. During 2019, Tetragon used $493.3 million of cash to make investments, $50.3 million to repurchase its shares, and $44.8 million to pay dividends. $476.4 million in cash was received as distributions and proceeds from sale of investments. In terms of future cash commitments, they are as follows. In total, Tetragon has $217.4 million of cash commitments. Those comprise hard investment commitments to Benthall Green Oak funds of $54.9 million, private equity funds of $31.1 million, and TCI3 of $14.1 million. Tetragon also has soft investment commitments to Banyan Square Partners of $85 million and the Hawks Point Fund of $32.3 million. Lastly, I'm going to cover our future investment expectations. I'll go through a few of our expectations, but it's always worth pointing out that one of our advantages is our ability to be opportunistic as it relates to investing in what we see as the most compelling investment opportunities. As mentioned before, we launched Banyan Square during 2019. Aside from Banyan Square, we have no upcoming new businesses to report. TFG Asset Management, therefore, remains the largest unknown in terms of cash requirements. In terms of our event-driven exposure, our convertible bond exposure, and our quantitative strategies exposures, with our event-driven equity exposure, we expect that to remain relatively stable over time. We expect our convertible strategy to increase somewhat over time, and as Patty mentioned, we expect to reduce our allocation to quantitative strategies. In terms of bank loans, our pre-crisis CLOs are now fully amortized. But we do expect to continue to invest in CLOs via TCI3 and subsequent vehicles such as TCI4, and we expect to invest at the rate of $25 to $50 million per year. In terms of real estate, while we do have commitments to Bentall Green Oak funds, we would also expect some of our existing investments to continue distributing capital. So on the whole, we would expect our real estate investments to be relatively stable over the next 12 months. In terms of the private equity bucket, we would expect those allocations to grow over time. There are a few small additional LP commitments that we have yet to fund, and we expect the Hawks Point and Banyan Square allocations to continue to grow. Lastly, in the other equities and credit buckets, that's similar to TFG Asset Management. We expect to continue to invest in these opportunities, but the timing of those investments is less certain. So with that, I'm going to turn it back to Patty to address some of the questions.
Thanks, Steve. And thanks very much, everyone. A lot of questions have come through. What I thought I would do as I sort of sift them here is try and tackle those relating to the portfolio first, and then move on to thematically those that are more about the structure of the company and the discount and buyback and the like. So just tackling a few questions on the portfolio. I'm going to start with a question on Ripple. It reads, I'm still waiting for an official statement about the Ripple transaction. Don't you think this would be very important to give more color about this transaction from your end? Otherwise, only rumors spread, and even more important, it would lead to more transparency, which is one of the big criticisms from outside shareholders. Understandably, if you don't even make an announcement about a meaningful transaction. So Tetragon invested in a Ripple Labs private equity offering in December, and that was announced by Ripple Labs at that time, and I think many of you as investors would have seen that announcement. Tetragon itself doesn't make announcements every time it makes an investment, as I think you would see as perfectly normal, and so in line with that, Tetragon did not make an announcement. However, our annual report does refer to this investment, and it does so both in the letter, or the letter to shareholders at the beginning of the annual report, but also this investment is now represented in Tetragon's top 10 positions. I would just add that I think in many ways the investment exemplifies some of the key investment tenets that we have. We're always looking to source interesting investments, and I would note that this was sourced proprietarily. It's a private company, and we didn't source this through an intermediary or bank or the like. Secondly, we like to invest in strategies, as you know, that have idiosyncratic returns, and we think that Ripple Labs is a very exciting company with huge potential, but not necessarily correlated to market returns. And also, we like to negotiate secure investment structures for Tetragon, and we believe own a very attractive security in Ripple. The second question I had was on the QT fund. It says Tetragon has circa $50 million invested in QT fund that's delivered mediocre returns which barely cover management fees. Surely this sum would be better put to use in buying back stock. Is there any particular reason why you persist with this investment? Well, I would say that, firstly, as mentioned in the annual report and in the presentation we've just given, we have actually redeemed out of the QT fund and expect our redemption proceeds in the second quarter. But to give a little bit more colour, we would agree that the performance of the QT fund has been below and certainly below our expectations and also below their expectations. But when we do make these investments with managers, we're generally in search of those that can produce high risk-adjusted returns in a non-correlated fashion over multi-year periods. And we don't always find them, but when we do, they create very high repeatable return on equity for Tetragon, which is obviously our goal. And that is why we persist, and in many cases, we're prepared to take our time. Third one is on Sirius Minerals. The question is, would you like to comment on your reasoning and expectations with regards to Polygon's holding in SXX? And the simple answer is no, I'm not in a position to comment on that position. And the last one on the portfolio is about cash management. The question reads, I notice your cash levels are lower than historically and that you've drawn your revolving credit facility. Is there enough cash on hand for interesting investment opportunities should they arise? I think this is a good and very important question, and obviously particularly relevant given the market declines over the last week. Just to reiterate some of the numbers that we gave in the presentation and to give clarity, the year-end cash number was 55 million, but that does include, as Steve said, all known accruals and liabilities. In other words, that 55 million is net of the $150 million known liability that is the revolver. So just simply adding that back gives 205 million. And even though that liability to pay the revolver back has several years of duration. So if one looks at the actual cash on the balance sheet at year end, somewhat higher than the 55, given that that is the accounting number. So that's the first thing to understand. The second is when we talk about our known cash commitments, Steve showed a number of $217 million, which he then itemized. And I think you will see that over half of that number are soft commitments, i.e. that we still have discretion over, not hard commitments. Point of bringing out those two numbers is that it's different, when one takes those into account from the initial just observation of 55 million. And most importantly, I would say yes, we keep a very close eye on cash management. We try to ensure we have enough cash for when interesting investment opportunities arise. I want to move on now to answer some of the questions which are more structural related. In no particular order, there's one here that reads, for all the excellent growth in the NAV, investors have not seen much benefit. Have you considered returning a fixed percentage of NAV as a dividend, say 4%, thus allowing shareholders to directly benefit in future value creation? I would be very surprised if TFG traded at a 50% discount for long at an 8% yield. Well, I guess I got sort of two answers to that. The first, we should just talk a bit about the dividend. The dividend has been, since inception, considered as we want to have a progressive dividend. We don't want it to be volatile with the quarterly or even the annual NAV. We would like to look back over 5, 10, 15, 20 years and see a growing dividend that represents what we think is the repeatable performance of the business as we build over the years. So certainly it is not the intention to have a yield that could go up and down with the NAV. That's not the objective. The second comment I'd purely make is one about markets. Tetragon yields roughly 6.3% at current levels. The US 10 years now down to 120, that sort of magnitude. And the shares traded at a 50% discount to their net asset value. So I certainly wouldn't want to make any predictions as to what is possible or not within the market. Certainly the current yield at 6.3 versus risk-free of of closer to 1.2 is a huge pickup over that. There were quite a few questions relating to the discount to NAV, and I'm going to read a few because they all have slightly different angles to them. I've been a shareholder of Tetragon for 3 years, and I'm pleased with the investment returns which are being achieved. I have added to my holding and taken some dividends as scrip. I'm surprised by the high level of discount and wonder if the board has considered moving to a standard listed stock on the London Stock Exchange, as this would provide greater interest from UK investors, as for a start, index fund managers would be strong natural buyers. Unless Tetragon is gaining considerable support from its Euronext listing, I believe having LSE as TFG's principal listing would catapult TFG into the FTSE 350 mid-cap index and could be significant value in building Tetragon's profile. My answer to that is that we're always looking for solutions to the discount, and I'm going to talk a bit more in a moment. But very specifically to that question, we're not currently eligible for the LSE standard list, and that is primarily due to our non-voting share structure. Second question, no buyback this year. Is it wise to impose dilution via scrip dividends when the discount is so wide? Those who don't wish to or can't reinvest dividends are being penalised and having NAV diluted due to a lack of buybacks to negate scrip dividends. So firstly, technical point, there was actually a buyback in January of last year, but I do take the point there wasn't one later on in the year. I think the question is really about the scrip dividend, and we see that as a separate issue. It has been in place since inception at the request of shareholders, many of whom prefer receiving it to cash. And I accept that some investors may not wish to do so, but obviously they could always prevent the dilution by taking them a scrip or indeed reinvesting the cash. So it's not necessarily penalising them, and I think it's very efficient for those shareholders that are requesting it. Another question. The discount has widened this year. It's been said the company is focused on returns and share price will take care of itself. It clearly hasn't. And what was done previously to narrow the discount hasn't worked. Surely it's time to try something else. The second question. Does the board intend on trying to reduce the discount to asset price or let the market dictate the price? And thirdly, I'm sure you've had many similar requests, but just in case you do not, during the investor call, could you please discuss what actions you've taken and plan to take to reduce the discount to NAV? So I think within this, there's sort of a lot of questions that I'd like to address. But the broad one on what the market price is, I think we can be clear. The manager obviously can and does do its best to grow the NAV per share of the company and return on equity, and indeed the dividend. But the market will determine where the shares trade versus that NAV, and that's the same for every publicly traded company. We're no different. I would say, though, where we are different is we, and that is to say the managers, principals, and employees of Tetragon's owned TFG Asset Management, own approximately 30% of the shares and care hugely about how those shares reflect the true value of the business. And so, of course, we are very concerned at the discount. We talk to many, many shareholders and potential shareholders, and when we speak to shareholders, there are multiple reasons that people postulate for the discount. And some of those I'll talk about now. They are the complexity of what we do. People don't like that complexity. They certainly don't understand, or many people don't understand a lot of the things that we do. If people find the liquidity of our shares frustrating, as it is bifurcated amongst not just LSE and Euronext, but about 8 OTC venues as well, and people quite often don't see the aggregate liquidity. Some people say it's the fact that we own illiquid assets and that the closed-end funds market is always wary of illiquid assets. That it's confusing that we own operating businesses, and by that we refer to TFG Asset Management, as well as more passive investments. A lot of people consider it just because we're investing in alternatives. Some people think it's the fees. Some people don't like the 6 months look-back high water mark. Non-voting shares is sometimes an issue, which I've touched on already. Some people think it would be solved without an external manager. Some people think that it's the current shareholder list with a high bias towards US hedge funds, and some people see that as a potential selling overhang. And some people just say it's not a pure play and they like to invest in pure plays. And the last one, and perhaps the most frustrating, is some people say it's at a 50% discount because it always has been, and that's how people trade closed-end funds. And these are just to name a few. There was an interesting piece written by JP Morgan, one of our brokers, covering, in their view, all the reasons Tetragon might trade at a discount. And their conclusion was that whilst many of these may argue for a discount, none of them explain the aggregate to be currently near 50%. I would say that the long-term solution is one where the manager has to continue to make good investment returns. We have to work hard to always be improving the investment process. We're always trying to help create repeatable returns. And then if we can do those two things, we need to be perpetually educating the market and as many investors as possible as to what we see and what we do. And we still take many meetings every quarter with investors, and many of them have still never heard of Tetragon. So there's a lot more we can do in that space. So really it's about making sure the potential shareholders know what we do, and it's a very long-term process. We have JP Morgan and Stifel as our joint brokers. We have engaged Edison and Kepler, and we have a program of investor meetings every quarter, and we're committed to continuing with that education to investors. But also I would remind you that we have a NAV of nearly $2.5 billion. So it is not a small enterprise, and it doesn't get changed with just a few buyers. So that's what I wanted to say on the discount. There are some couple of questions on buybacks. One is, are there any plans for a tender in 2020? And the second is, given the current 50% discount to NAV, would it be an opportune time for remaining shareholders to enact some buybacks? What I would say is, firstly, there are no current plans for a share buyback. However, historically, the company has always been very opportunistic in its approach to buybacks. And that is to say, at any given time, we take note of our cash balances, the share price discount, what the investment opportunities are, and balance out the NAV per share accretion that might accrue from a buyback with the alternative investing opportunities. So whilst to reiterate that we have no plans currently, and obviously, as we've discussed already, cash is lower than it has been historically, things can always change. Last two things I would say on buyback are, firstly, the historic context. We have, or the company has, enacted $660 million of buybacks life to date. And the second thing, whilst that is great for NAV per share accretion, it is also evidence, and we're not the only company that has shown that, but there's plenty of market evidence, that actually buybacks are not a panacea for share price discounts. And lastly, still on structure here, do you think your company would be better appreciated if the domicile and quotation was moved from the UK to the US? Well, I think it would only be speculation, and I'm not going to speculate on this call, but a few comments I can make. We actually have a very high level of US investor interest in the company compared to most UK closed-end funds. I would say the corollary of that is we don't have enough UK investors compared to our counterparts, but certainly we do have US investors, and US investors can own Tetragon in its current format. And we have a US office. We spend a lot of time talking to US investors. But more to the point about, would we consider a different domicile? I would say that, we're always looking for possibilities, and in fact, we have looked at this one in the past, but would want to say that we have nothing currently under review along these lines. And I think that finishes the questions. So with that, I'd just like to leave it there and say thank you very much for joining us, and we'll talk to you soon.
This now concludes today's webcast. Thank you all for attending, and you may now disconnect.